Good afternoon, everyone. Happy Diwali to all of you. And I believe you must have enjoyed this Diwali, as I did, of course. And I welcome you all again in our revisionary class of income tax. Today, we will be discussing chapter number 4 and chapter number 5. That is regarding clubbing and set off and carry forward of losses. So these are two very important chapters to calculate your GTI, etc. It could be asked in the examination in the form of a small question or even theoretical purpose also. It's very important. It could be an individual question also from a set of chapter. And I recently noticed that in continuous attempts, the set of question has been framed by the institute, having almost 5 to 6 marks weightage in every attempt in November 24, I guess in sorry, not November 24, it's May 24, in November 23, etc. So today we will discuss those chapters, the important provision, test your knowledge question, MCQs also, and past year question paper also, in which these questions from these two chapters have been asked. So I believe you all must be studying very hard, and as well as you must enjoy your Diwali. So let's get started with today's session. First, we will discuss clubbing provision. That is technically inclusion of any other person income in the assessee's income. So the general rule regarding the income tax is you need to pay tax on your income. But in some cases, in some situations, in some specific circumstances, there are instances in which income of other person included in assessee's total income. That's why this chapter is there. So when we think about the word clubbing, the clubbing general meaning to be together. We know the meaning of club. What is the meaning of a club? When a lot of people come together and enjoy a party. So that means clubbing. So clubbing means addition, a group, a consolidation. But in this chapter, we are talking about clubbing of income. So if I earn some income, then I need to pay tax on it. Okay. But there are some instances in which I need to pay tax on some other person income also. But that does not mean that income tax is doing something wrong. They are not intentionally doing it. They are doing it because we are trying to avoid the tax. Why and how it happens, let me explain this first. Then we will move on to the provision, the test your knowledge question, etc. Okay. So let's get started. There is a summary. We will discuss it later. First of all, let me explain why clubbing provisions are there, why the need of these kind of provision has been emerged. That's why Income Tax Department has provided these specific section. Why it happened? Suppose there is Mr. A, okay, and his income is 10 lakh rupees for the year from business or salary, whatever it is. So as per optional tax regime, approximate the tax would be almost 1,12,500 rupees. Okay. And cess, etc. is going to be imposed again. But now Mr. A, suppose, purchased a house property or any other asset. And suppose by renting this, he let out this property for 5 lakh rupees per annum. Now, what will happen if this income is going to be taxed in the hands of Mr. A under optional tax regime? Then tax would be at the rate of 30% because income exceeding rupees 10 lakh. So that would be approximate 1,50,000. So Mr. A needs to pay tax on this rental income of any asset. Whatever he earns would be almost 1,50,000 rupees, and cess, etc. that will be extra. So Mr. A thought, what should we do to avoid this tax? So he's saying that his wife, Mrs. A, she was a housewife having nil income. She has no income. She's earning nothing. She's a housewife. She does not any income from her sources. So Mr. A decided that why should not I transfer this income into the hands of Mrs. A? I will make a registered agreement that the rent, whatever I am receiving from this property, from this asset, would not be treated as my income. That rent should be credited into the account of Mrs. A directly, 5 lakh rupees in a annum. So what will happen in this situation? This 5 lakh, if would be treated as the income of Mrs. A, then what will happen? There would be nil tax, because under optional tax regime, there is 2,50,000 rupees basic exemption limit. Then there would be a rebate up to 5 lakh rupees income. So due to this provision, the tax would be nil. So if Mr. A includes this income in his hand, he needs to pay approximate 1,50,000 rupees tax. But due to this practice, they can avoid the tax completely, and the income is within the house. Whether it's earned by Mrs. A or Mr. A, how does it matter? So in this situation, he can avoid the tax liability of approximate 1,50,000. There could be more instances like this. He could transfer this income to in the hands of his son, daughter, etc., in the hands of minor also. So to curb this planning, to stop this practice, to ignore or avoid or nullify this avoidance of tax, the clubbing provision has been introduced in these kind of situation. So the provision says that if the asset is in your name, you cannot transfer the income alone. So income would be treated in the hands of the person who actually holds that asset legally. So Mr. A just transferred the income in this situation. So the asset is still in the name of Mr. A. So in this situation, this income would be treated as the income of Mr. A, the transferor. So the provision has been made that the asset, the income would be treated in the hands of the person who hold that particular asset legally. So this practice has been avoided. But now one more practice has been started. Mr. A say, okay, in this way we cannot avoid the tax. So again, suppose there is Mr. B. His income is again 10 lakh rupees. Approximate tax is 1,12,500 rupees. He again owned an asset, suppose a car or anything else, and getting 5 lakh rupees rental income. Again, there is Mrs. B having nil income already. Now Mr. B comes to know that if I transfer only the income, only income has been transferred as in the first case. So the department will add that income into my income, because the provision has been made that the income would be taxable in the hands of the person who hold that asset legally. So let's do one thing. We transfer this asset as a gift into the name of Mrs. B. I will legally going to transfer the ownership of this asset into the name of Mrs. B. So now the asset belongs to Mrs. B. So as well as the income should also belong to Mrs. B. So in this situation also, we can arise income in the hands of Mrs. B, and the tax would be nil. So this practice has been started. So again, to avoid this practice, section 64 has been made that if you transfer any asset to your spouse without consideration or without an agreement to live apart, in that situation, that amount is going to be clubbed in the hands of Mr. B. So as people start avoid the tax, the provision has been made. So technically, for these kind of practice, to stop these kind of practice, to stop, to curb, to avoid, to nullify these kind of tax avoidance provision, this chapter has been introduced, and it has involved these kind of clubbing provision in respect of spouse, in respect of son's wife, in respect of minor children, etc., etc. We have multiple provision regarding this. So first of all, I'm just trying to explain to you why the introduction of this chapter has been made in our act. I hope it's clear. Now moving on to the provision, what exactly it says. Let me share you the slide. The provision from your study material, which has beautifully drafted this chapter by the BOS, by the ICAI. It's a very interesting chapter, having almost 18-19 pages chapter. So You should understand with the help of this diagram also. It's very interesting diagram. Everything has been covered as a summary in this diagram, which explain you one by one what is exactly the clubbing provision says. You must have gone through with this provision in detail in the live classes also. So I will only take up the important provision and as well as the test knowledge question important, the illustration importance and the MCQ we are going to discuss and the past year question, etc. Okay. So clubbing provision, the income of other persons includable in assessee's total income. So the first point that the example I have explained it to you, it says transfer of income without transfer of asset. So if that is the situation in which asset has been not transferred, but the income has only been transferred. So that would be fall in the section 60 cases. And you can see it's very simple. It says if any person transfer the income alone from any asset without transferring the asset itself. So if this is the situation, even if you are transferring this asset to Mrs. A or any person without transferring of the asset, only income has been transferred, then that income is to be included in the hands of the transfer. Very simple. It is irrelevant whether the transfer is revocable or irrevocable. What is the revocable transfer? What is irrevocable? That we are going to discuss under section 61. So it does not matter whether the transfer was revocable or irrevocable. If only the income has been transferred to any person, whether spouse, children, friend, stranger, etc., that income would be treated as your income. That section 60 explained. Okay. We have the example also that what we have already discussed. Now, what is revocable transfer? Revocable means which can be reacquired. So the transfer should be irrevocable. If it is a revocable transfer, that means you would be treated as the owner of that asset for all the time and income would be taxable in your hand. So the provision says all income arising to any person by virtue of revocable. What the meaning of revocable? That would be reacquired. So if the transfer is revocable, that means we can reacquire the asset. It would not be treated as transfer and that income is going to be taxable in the hands of the transfer. Meaning of revocable transfer means it says it contains any provision for the retransfer directly, indirectly of the whole or any part of the income or the asset, or it gives anyway the right transferor a right to resume the power directly, indirectly. Clear? Now there is an exception also that has been discussed in section 62. So section 61 talks about the revocable transfer. Now it says there are some cases in which these provision would not be applicable. So that means section 61 will not apply. That means following transfer will be treated as irrevocable. If that has been mentioned in the agreement arising to any person, if there is a transfer by way of trust which is not revocable during the lifetime of the beneficiary. So if I transfer my asset to anyone and there is a clause that I will reacquire that asset after the death of that transferee, then it would be treated as irrevocable up to the death of that transferee. So whether you are transferring to a trust or whether you are transferring to any other person, if it is not revocable up to the lifetime of the transferee or the beneficiary, it would be treated as irrevocable till the time of that contingency happen. Till that, there would be no taxability in the hands of transferor. It will be only in the hands of transferee. After that event happen, after the death, etc., again the income would be taxable in the hands of transferor. So till that event happen, no clubbing provision would be applicable. After that, clubbing provision would be applicable. That must have been discussed in the detail in the live classes also. So I'm just going to give you a revision of basic provision. So you would be able to understand when we will solve the MCQs, last year question, etc. Okay. In the above case, etc., you can go through with the example. Now, income of other person, including in individual's total income. Let me share you the provision. This is the basic summary of section 61, what we just have discussed. Section 60, which says transfer of income without transfer of asset. We just discussed about this provision. Section 61 says income from revocable transfer would be taxable in the hands of transferor. And there are section 62 which talks about the exception. There are certain cases in which even you can reacquire the property, but it would not be treated as revocable. If there is a clause that you can reacquire it after the death of the transferee. Okay. Now, section 64 talks about clubbing in case of a spouse, clubbing in case of son's wife, clubbing in case of minor child, etc. In case of a spouse clubbing, there is three basic provision in case of remuneration. If the spouse is getting remuneration from any organization in which the other spouse having substantial interest, then clubbing provision would be applicable if the spouse getting the remuneration is without any talent or qualification. You must have gone through with the provision. So in case of remuneration, if no talent, no qualification, then clubbing would be applicable if substantial interest of the other spouse in that organization. If there is qualification and talent exist, then there is no clubbing. If both spouses do not have any talent, but they are working in the same organization and they both having substantial interest, then what will happen? Who will give the answer? Let me see. If I am asking a question that suppose in the case of clubbing in case of a spouse, suppose there is Mr. A. Let me frame a question and then you will answer. Okay. So the provision says, suppose there is Mr. A or Mrs. A, who is a chartered accountant working in XYZ Limited and getting a salary of 5 lakh rupees per month. She is also having voting power of 30% in this XYZ Limited. So that means she is having substantial interest. We know the percentage is 20% or more. If you have a voting power in any company, 20% or more, you will have a deemed substantial interest in that organization. Or in case of other than a company, if you have a profit sharing ratio of 20% or more, that would be the substantial interest. I guess section 232 talks about the definition of substantial interest, as I remember. Fine. And there is Mr. A also. Suppose he is a house husband. So he does not do anything. He's a house husband. He maintains the house, all the work of housekeeping, etc., cooking, etc. He has done over there. So now Mrs. A, Mr. A also got a job in XYZ Limited and earning is suppose 50,000 per month. Now questions say that if Mr. A is having any qualification or skill or talent, qualification does not require or mandatory that you must have a degree, etc. But if it has been proved that Mr. A has got this job on his own talent, in that situation, there would be no clubbing. So if Mr. A got this job, it has been proved. So it will depend upon case to case basis. So if he is working on the basis of his own talent, in that case, there would be no clubbing. So this income of 50,000 would be taxable in the hands of Mr. A. But if it has been proved that Mr. A does not have any talent, any qualification, any knowledge, then it would be assumed that this job has been due to the substantial interest of Mrs. A. So the income of 50,000, whatever Mr. A is gaining actually would be taxable in the hands of Mrs. A. This is point number 1, in which it says in case of remuneration where one spouse having substantial interest in an organization. But my question is different. I want to ask something else. Now I am framing a question like this. Suppose there is a ABC Limited. There is Mr. A having, suppose, 26% voting power. Mrs. A, suppose, having 28% voting power. He's getting salary 5 lakh rupees per month. His other income is 10 lakh rupees. Mrs. A's salary is, suppose, 6 lakh rupees per month. And her other incomes are 9 lakh rupees. 9 lakh rupees, okay? So now suppose they do not have any talent, any one of them, Mr. A, Mrs. A, do not have any talent, any qualification, etc. So the question arises, if they both are talented, there would be no clubbing. But suppose if they do not have any qualification, they both have appointed due to this substantial interest. Now, how's the income of this income is going to be clubbed in the hands of which person? So 5 lakh is going to be taxable in the hands of Mrs. A per month, or 6 lakh is going to be taxable in the hands of Mr. A per month accordingly. So what is the criteria when they both having substantial interest in an organization? So let's see who is going to answer. What is the basis of this? Mr. A, because his other income is higher. Okay. 5 lakh in the hands of Mrs. A, who is saying Om Krishnan, Pooja is saying Mr. A. Income will be included, Shoaib is saying, in the hands of a spouse whose total income is higher. In this case, salary of both will be included in the hands of A. The correct answer is the correct answer is income should be clubbed in the hands of Mr. A, because the provision says in this situation, the income would be clubbed. The salary, the remuneration will be clubbed in the hands of that person whose other income except this salary income is higher. So the other income is Mr. A is 10 lakh rupees. That is higher. So Mrs. A's salary of 6 lakh rupees per month is going to be taxable in the hands of Mr. A. Other income would not be clubbed. Mrs. A, other income 9 lakh is going to be taxable in the hands of Mrs. A. But only the remuneration is going to be taxable in the hands of Mr. A. Okay. Well done. Moving on to the provision, what we were discussing over here. So clubbing point number 1 is regarding this. Of course, the remuneration from a particular concern in which the individual has substantial interest. Remuneration in cash or kind does not matter. This provision we have discussed already. Circumstances where, in the case, this is a definition of substantial interest. In case of a company, 20% or more of voting power. In case of other, 20% or more of profit sharing ratio. Clubbing provision would not apply where remuneration is received on account of technical or professional qualification. We have discussed that, of course. Both husband and wife have substantial interest. Then we have discussed in that situation, the person having higher income other than this remuneration in that person head, that salary is going to be taxable. So both husband and wife having substantial interest in a concern, both are receipt of salary. Such income will be includable in the hands of that spouse whose total income excluding such income. Such income means that salary or remuneration is higher. Once it has been done, in the future year also, that provision would remain the same until the assessing officer changed it on the basis of fact and circumstances. So you can see with the help of an example that must have been discussed in the live class also, that Mr. A holds shares carrying 25% voting power in X Private Limited. Mrs. A is working as a computer software program in XP Limited of a salary of 30,000 per month. She is, however, not qualified for the job. The other income of Mr. A and Mrs. A are 7 lakh and 4 lakh. So other income higher is Mr. A, other income is higher. they do not, and Mr. A holds the voting percentage also. Mrs. A does not have that percentage, substantial interest. So the salary of Mrs. A is going to be taxable in the hands of Mr. A due to the substantial interest of Mr. A. If they both have substantial interest, then in that situation, other income is going to be checked. You can see the solution. If Mrs. is qualified for the job, of course, there would not be any clubbing provision applicability. Okay, moving on to the other provision, we have to cover a lot of provisions of clubbing, the set of provisions, both chapters MCQ, both chapters past year question, some important test your knowledge question also. So we are covering these provision. Income arising to spouse from an asset transfer without adequate consideration. So I've explained you in the example that in the second example, when I have discussed with you that Mr. B decided to transfer the property in the name of spouse. So if income would be taxable in the hands of a person, as section 60 says, in the hands of the person who hold that asset. So now we start transferring our asset into the name of a spouse. So this department had made provision that if any asset has been transferred into the hands of a spouse other than house property. Why house property has been excluded? For the purpose of house property, there is specific provision, special provision under income from house property. So if the house property has been transferred, the deemed owner concept under section 27 will be applicable. If that is other than house property, then section 64 provision would be applicable. What section 64 say? It says if you transfer any asset to your spouse without adequate consideration and without divorce, either you have received the adequate consideration, no clubbing applicable. If you have taken divorce, then still there would be no clubbing. So if you have received any of that thing, either divorce or adequate consideration, there would be no clubbing. And if nothing has been received, then there would be clubbing as per the provision if that property is other than house. Okay. This specifically says without consideration or otherwise then in an agreement to live apart. That means in a normal language, we are talking about divorce. Divorce, divorce, whatever it is. Okay. Any income arising to the transferee spouse from the transferred asset, either directly or indirectly, shall be included in the hands of transferor spouse. Why house property has been excluded? Because in case of house property, section 27, which talks about deemed owner, there's a provision exactly same copy paste, which says if a house property has been transferred from one spouse to another without adequate consideration and without an agreement to live apart, in that situation, the transferor would be treated as the owner. That will be treated as a deemed owner. Because the registered owner would be that person in which hand the asset has been transferred. But as per income tax, the transferor would be still treated as deemed owner. So it would not be considered as any transfer has been done. So we will assume that transferor still is the owner. So there would be no requirement of clubbing applicable. Automatically, when he has been treated as the deemed owner, the rental income would be taxable in the hands of the transferor only. So the implication would be same in both the situation, whether there is a house property or where there is an other asset. The income is going to be taxable in the hands of transferor. The difference is in case of other asset, the transferor in the transferor hand, only income would be treated as its asset, as its income. But in case of house property, the house and the income both will be treated as the ownership in the hands of the transferor. So there is a difference of only this treatment, but the taxability of income would be remain the same. So always remember, if in the examination the transfer is regarding house property, then you would apply as per section 27. And if it is any asset other than house property, then section 64 would be applicable. In case of transfer, this is an important provision for your examination. Everything is important. This is more important. Transfer of house property, the provision are contained in section 27. If an individual transfer a house property to his spouse without consideration or divorce, the transferor shall be called the deemed to be the owner of house property. And it's automatically you are the owner and the income would be taxable in your hands only. The third point says that is income from accretion of the transferred asset. So if you earn any other income from the income, that is going to be taxable in the hands of transferor. Upon that income, this clubbing provision would not be applicable. Suppose there is a car which has been transferred by Mr. A into the name of Mrs. A. The rental income is 5 lakh rupees. So the car has been transferred without adequate consideration, without divorce. So this 5 lakh would be treated for the purpose of income tax, would be treated as the income of Mr. A. But practically, this 5 lakh is received by Mrs. A in his bank account. He invests this 5 lakh rupees in a FDR and getting interest of suppose 40,000 rupees per annum. This 40,000 is not going to be taxable in the hands of Mr. A. This is going to be taxable in the hands of Mrs. A only. So it may be noted that any income from accretion of the transferred asset is not to be clubbed with the income of the transfer. So you can see the direct income which has been earned by the transferee from that transfer activity is going to be clubbed. But this is indirect income. This is the income on that clubbed income. That is not going to be taxable. Meaning of adequate consideration, you must have discussed. Transfer asset invested in business. Now, this is very, very important. In my opinion, if there is an examination, something can be framed as a question, as a practical individual question from this chapter. So the very high probability that the clubbing provision, individual numerical or practical question could be framed from this provision, which talks about transferred asset invested in business. And I believe that it must have been framed in May 2023 examination. We will discuss that question, where the asset transferred directly, indirectly by an individual to his spouse. The same provision applicable to spouse is going to be applicable for son's wife also, except in case of remuneration. The same provision for asset also, except in case of building. This provision also applicable in this case. Are invested by the transferee in the business, proportionate income arising to the transferee from such investment is to be included in the total income of the transfer. So the provision says if you give some amount directly or indirectly to your spouse, and that spouse invested that money into the business, then whatever is the proportionate amount of income which has been arised due to your investment, which has been given by you to your spouse, is going to be clubbed in the hands of the transferor. Such investment proportionate value, okay? What is the proportionate value? How we will find out? We will solve with the help of an example. In the total income of the transferor, the very important thing, the very important line is I'm going to tell you, which you should actually focus whenever you are going to solve this question. If the investment is in the nature of contribution of capital, proportionate interest receivable by the transferee from the firm will be clubbed with the income of the transfer. Now, what is the main important thing you have to remember is this. This is utmost important. Such proportion has to be computed by taking into account the value of the aforesaid investment as on the first day of the previous year. So your previous year is 23-24. So for that purpose, we have to see what is the investment amount which I have given to the spouse at 1st April 2023. So if I have transferred that amount or if it has been invested after 1st April, then for that year, there would be no clubbing provision applicable. So whatever has been invested as on 1st April 2023 is important to the total investment in the business or by way of capital contribution in a firm. As a partner, as the case may be, by the transferee as on that date. So please, please, please remember this provision very firmly. Okay. Now, what is the illustration says, how you will solve it? Mr. Vaibhav start a proprietary business on 1st April 2022 with a capital of 5 lakh. Clear? He incurred a loss of 2 lakh rupees during financial year 22-23. So his capital would remain 3 lakh rupees. Clear? After the loss, to overcome the financial position, his wife, Mrs. Vaishali, a software engineer, gave a gift of 5 lakh rupees on 1st April 2020. So now you can see the Vaibhav capital was 3 lakh on 1st April 23 and her wife capital is 5 lakh. So total capital in the firm on 1st April 23 is 8 lakh rupees, out of which the proportion of Mrs. Vaibhav is 5 lakh and his proportion is 3 lakh, which was immediately invested on the same day by Vaibhav. He earned a profit of 4 lakh rupees. So now I have to proportion this 4 lakh rupees into this ratio. As simple as that. How we will solve it? 4 lakh divided by 8 lakh into 5 lakh. So you can find out the amount which need to be clubbed in the hands of Mrs. Vaishali. So that would be 4 lakh was the profit. ₹2,50,000 is the ratio which need to be taxable in the hands of Mrs. Vaishali. I hope it's clear. So you have to check in the question what is the capital contribution on 1st April 2023. Suppose in this question the investment in the business is after 1st April 23. Then there would be no clubbing for this year in the hands of Mrs. Vaishali. The clubbing would be applicable in the next year. Clear? Income from other source provision would not be applicable because it is from relative, that means his wife. The question also asks, what if that amount has been given as a bona fide loan? So if it is a loan, that means it's a liability which need to be repaid. In that case, there would be no clubbing. Clubbing will be applicable if there is a gift, etc., without consideration. Now, transfer of asset for the benefit of spouse, the same provision. If you transfer the asset to someone else, but the benefit is going to accrue to your spouse, the clubbing provision till that extent of income is used for the benefit of spouse going to be done. Almost same copy-paste provision in case of son's wife. If you transfer any asset to your son's wife without consideration, of course, divorce would not be applicable in this case. That is going to be clubbed in the hands of transferor. Again, the amount has been given to son's wife, and again, she invested in the business. The same concept of proportion would be applicable. Even if you transfer the asset for the benefit of son's wife, the again, same provision would be applicable. Not applicable in case of son. But for the purpose of son's wife, it would be applicable. So technically, clubbing provision is applicable on 3 persons: your spouse, your son's wife, and your minor child. Only these categories has been covered in case of clubbing provision. Okay. The example you must have gone through in the earlier class also. Clubbing of minor's income. In case of minor income, there is very simple provision. In case of minor child, if he earn income from anywhere, in case of minor, there is a very simple provision which says all incomes of minors, all incomes of minors is going to be clubbed. Only there are 3 exceptions. If that is earned by her skill talent, or if child is suffering from disability under section 80U, suffering physical disability. In these situations, there would be no clubbing. Otherwise, in almost all cases, there would be clubbing. And if the child income has been clubbed in the hands of a parent who is having higher income, except this clubbed income, the income is going to be clubbed in the hands of that parents. And if there's a divorce, then income would be clubbed in the hands of the parents in which who maintain that child. There's an exemption also, section 1032, which says there could be an exemption of 1500 rupees per annum or the amount of income clubbed, whichever is lower, that could be claimed. There is no limit of children in this situation. Let's discuss with the help of the provisions. So all income of minor is to be clubbed, all income except specialized knowledge or talent or involving skill, etc. Income will be clubbed in the hands of parent having higher income. Once income has been clubbed in the hands of parent, it would be continue. If the marriage does not subsist, that means after divorce, the divorce has been done, then the clubbing will be in the hands of the person who maintained that child. If child is suffering from handicap, is disability, then no clubbing would be applicable. It would be noted that clubbing provision are attracted even in respect of minor married daughter. Why it specifically has been said that clubbing provision would be applicable in case of minor married daughter? Are there any other provision regarding minor married daughter? I believe you must have gone through with the provision. Who will tell me the provision anywhere else regarding the minor married daughter? Why it has been specifically said that in case of minor married daughter, clubbing provision would be applicable? Why it has been specifically said? Swati is saying, okay, sir, if there is complete question, Shoaib is asking, with multiple heads, so when to club the income? Very good question, Shoaib. Like club income is your income. So if there is any income which is going to be clubbed in income from other source, then you have to add that income in your income from other source provision. If there is any income which should be clubbed under income from house property, then you have to club it in the income your house property, because after the exemption, calculating 1500 exemption, because that is the same provision for set off, etc. would be applicable in this situation also. Swati is saying absolutely correct. Under income from house property, in the definition of deemed owner, that minor married daughter has been discussed. So if you transfer your property, your house to your minor child, you would be treated as deemed owner, except in case of minor married daughter. In case of minor married daughter, if the house has been transferred, then she would be treated as the owner. But if any income has been arised on that property, that would be clubbed, same as section 64 provisions. Exemption, of course, that is 1500 rupees per month, but this exemption would not be applicable if you are under default tax regime. The same would not be available under section default tax regime under section 115 BAC. In case of a asset transfer to a minor child, not being a minor married daughter, without consideration for inadequate consideration, the same provision of section 27(1) would be applicable. You would be treated as the deemed owner of that property. Therefore, the income from property will be taxable in the hands of transferor parent, and you cannot get the exemption of section 1032 because it is not clubbed under section 64. It has been treated as the income of the transferor parents. Section 27(1). So if section 27(1) applicable in case of minor child, the clubbing exemption would not be there. But if the house property is transferred by a parent to his or her minor child, then section 27(1) would not be applicable, but clubbing would be done as per section 64(1). So you can get the exemption of 1500 rupees per month. So this is also very important. In my opinion, it's a very different provision. You should learn these provisions because that could be also asked in the examination. Now there's illustration 7. The same kind of illustration. The question is in test your knowledge question. So I will discuss this illustration like question in test your knowledge questions. Almost all the provision regarding clubbing has been done except this. This is cross transfer. Again, it's a very important topic for your examination purpose. Cross transfer means when there are two transactions in which we are transferring asset or money to the person, those are not covered under the definition of relative, etc. Just to avoid the tax. Suppose I transferred 5 lakh rupees to Mrs. B and Mr. B transferred a property to my wife. So there is technically, Mr. B wants to gift 5 lakh rupees to Mrs. B, but if it would have been done, then this clubbing provision would be applicable if there is any income from that asset or anything. So to avoid that, Mr. B asked me that I should transfer an asset to Mrs. B, and that income is going to be taxable in the hands of Mrs. B because we do not have a relationship of spouse, etc. And against that transaction, Mr. B gifted some property to my wife. So in that situation, because Mr. B and my wife does not have any relation, so there would be no clubbing in this situation. But technically, what is happening? I want to give that property to my wife, but if I would have done that, there would be clubbing. So I have asked Mr. B, I will give the money to your wife and you will gift an asset to my wife. So in that situation, we can avoid that clubbing provision and take the benefit of tax avoidance. So to stop that transactions, cross transfer has been introduced. And it says, if there are two transactions, look, language is very interesting, very fascinating. In the case of cross transfer, for example, A making gift of 50,000 to the wife of his brother B for the purchase of a house by her, and a simultaneous gift by B to A's minor son. So it could be between relatives of each other. Shares in a foreign company worth rupees 50,000 owned by him. So if I gift shares to my minor son, so income would be taxable in my hand. So I asked my brother, you gift shares to my minor son, it would not be clubbed. And I transfer or gift 50,000 to my brother's wife, so it would not be a clubbing provision applicable. So to stop that the income from that asset transfer would be assessed in the hands of the deemed transferor if the transfer are so intimately connected. Now this is the language, very interesting language from here. The deemed transfer, if the transfers are so intimately connected as to form part of a single transaction. So there are two transactions, but technically they are a part of single transaction of tax avoidance. And each transfer constitute consideration for the other for being mutual or otherwise. So thus in the instant case, the transfer have been made by A and B to the person who are not their spouse or minor child. So as to, this is also interesting, circumvent means gumana, like to avoid, to dodge, circumvent the provision of this section, showing that such transfer constitute consideration for each other. So in that situation, we would treat it that as a cross transfer. In case of cross transfer, clubbing would be applicable. There's a very interesting case law. I would preferably, if you are going to remember this case law, it's very good for your examination also. The Supreme Court in case of CIT versus Keshavji Morarji observed that if two transactions are interconnected and are part of the same transaction in such a way that it can be said that the circuitous method was adopted as a device to evade tax. So intention should be this. It will depend upon case-to-case basis. The implication of clubbing provision would be attracted. Accordingly, in this case, clubbing would be attracted and the income would be taxable in each other parents or husband hands. So the Vasudev gives a sum of 6 lakh to his brother's wife on 14/6/23 on 27/2023 his brother gift a sum of 5 lakh rupees to Vasudev Bhai. So in this case, he has transferred 6 lakh and the respective transfer is only for 5 lakh. So the common amount is 5 lakh rupees. So clubbing will be done of rupees 5 lakh, not 6 lakh. The gifted amounts were invested as a fixed deposit in the banks of Mrs. Vasudevan and wife of Mrs. Vasudevan brother on 1st August 23 at 9% interest. So this income is going to be clubbed in the hands of respective person due to this cross transfer. So you can read the solution also that must have been discussed with you in the normal classes also. The important thing is the income earned by his spouse on fixed deposit of 5 lakh alone would be included in the hands of Mr. Vasudev brother and not the interest income on 6 lakh rupees. Because the common transaction was up to rupees 5 lakh. So the cross transfer would be treated for only 5 lakh rupees income. I hope it's clear. Conversion of self-acquired property, very simple provision. If any member of an HUF transfer his property or throw his property into the HUF, then whatever income arise from that property is going to be taxable in the hands of that individual. So if who is a member of HUF convert at any time after so and so his individual property into the property of HUF for which he is a member through such property into the common stock of the family or otherwise transfer such individual property directly indirectly to the family otherwise than for adequate consideration. Of course, in that situation, the income from that property would be taxable in the hands of transfer. Even after there is a partial partition, I guess under section 171, there's a partial partition or whether it's a total partition. In that case, the part of that property which has been received by the spouse of that transferred person is also going to be clubbed in the hands of the transfer. Income include loss also, of course, distinction between section 61 and 64. You can go through with that. Now we will discuss first the MCQ and then we will move on to the test your knowledge questions. Okay, before that, let me see if there is anything to solve. There is no query as such. What is this? Just a second. Screenshots, whatever you are sending is not opening, but it's taking too much time, I guess. Okay. Partnership capital contribution. Okay, we'll move on to those questions that must be covered. Whatever question you have, that must be covered in our test and knowledge questions, of course. Sir, in case of section 64(2)(1), the HUF is capable of paying tax, even then it is held to pay tax through clubbing provision. Because that might be a case in which that individual is going to be covered in the higher slab rate. As explained during the starting of this class. Suppose that individual is having already 10 lakh rupees income and HUF income is only 2,50,000 rupees. That individual is having an asset for which he is going to earn 5 lakh rupees as a rental income. So he transferred that asset into the HUF. So now HUF would be pay tax with the rate of 5% or on 20% value. If that would have been not been done, that individual might need to pay tax at the rate of 30%. So it might be the cases that you need to avoid the higher tax slab rate. So you might need to transfer that asset into the HUF. So that would be a case, Swati BN. Okay. So let's discuss the MCQs. I hope you all are ready for these MCQs question from clubbing provision. After this, we will move on to our illustration and then there's a question of May 2023 that we will discuss. Okay. Very simple questions. Question number 1. Under which case Supreme Court observed that if two transactions are interconnected, Muskan is asking, Muskan Jamtani, how to write answers in exam. As explained in the RTP, MTP, in your study material illustration, you can see that what kind of answers you should expect. That must be in a specific format. So the examiner could understand whatever you have given in a specific format. Okay. What type of expectation ICAI has from the students? What kind of question is this, Muskan? Okay. So the correct answer is, of course, option number B. We have just discussed that. CIT versus Keshav G. Morarji, 1967 was the case law which discussed the provision regarding these provisions. Okay. Which of the following case clubbing provisions are not applied? Kindly read it carefully and that then give me the answer. Point number B, it is Minerson. Okay. This is called Minerson. Kavita Swati is saying D. Shoaib is saying D. Om Krishnan is saying D. Satwa Priya Nayak is also saying D. Well done, students. Very well done. The correct answer is, of course, D. So, in which case clubbing provisions are not applicable? Transfer by way of trust, which is not revocable during the lifetime of the beneficiary. It's an irrevocable transfer, so that would not considered as clubbing provisions. Third point, where the specified income to be included in the total income of the individual is a loss. Such loss will be taken into account while computing the total income of the individual. Specified income means there's those clubbing provision income we are talking about. So if the clubbing incomes to be included in the total income of the individual is a loss, such loss would be taken or not. So such loss would be taken into the account. So it is a true or false. Of course, we have discussed that your income is also include the loss. So clubbing is applicable on income as well as on the loss also. That is exactly the same treatment. So the correct answer is, of course, true. It's true. Very well done. Okay. Question number 4. Rohan CA is working as account officer in R Private Limited on a salary of 2 lakh rupees per month. He got married to Miss Poonam, who hold 28% share of this company. What will be the impact of salary paid to Rohan by the company in the hands of Mrs. Poonam? Need to be club 100%, 50% club, no clubbing, or 25% clubbing? Somebody is saying A. Om Prakash is saying C. Kushi is saying no clubbing. Shoaib is saying no clubbing. Option C. Due to his own qualification. Kavita is saying C. Well done. Everyone have you given the correct answer. Well done. Of course, because he's a qualified person, so he's getting the salary because he's a chartered accountant. So there would be no clubbing provision applicable. Question number 5. Mr. A, a fashion designer, lucrative business, pays salary to his wife, who is a model. Remuneration received by Mrs. A shall be included in the income of. What is the correct answer? Kavita is saying C. Satva Priya is saying A. Swati is saying A. Pooja is saying A. The correct answer is of course A because she's a model. So that's why there would be no clubbing provision would be applicable. Well done. Now question number 6. Mr. G has, now this is a question you need to solve. Mr. G has 4 minor children consisting 2 daughters and 2 sons. Okay. The annual income of 2 daughters was 7,500 and 5,000. And of sons were 5,500 and 1,250 respectively. The daughters who was having income of the daughters who was the daughter, of course, the daughter who was having income of 5,000 was suffering from a disability specified section 80. Work out the amount of income earned by minor children to be clubbed in the hands of Mr. G. So you need to tell the clubbed income. What should be the clubbed income? That is going to be find out by you. Take your time and give me the correct answer. Swaroop is saying C. Okay. Om Krishna is saying D. Yes, we need to find out the optional tax regime, not the default tax regime. You have to find out the answer as per optional tax regime. So she's saying 9750. I am not asking the amount of exemption. I am asking the amount of income need to be clubbed. Okay. Swati is saying again C. How much income is going to be clubbed? That is the question. Kindly read the question correctly. Question is not what is the clubbing exemption. The question is what amount of income need to be clubbed. Now Kuchi is saying 14250. Kavita is saying C. Swati is saying B. Most of you, I guess, giving the wrong answer, not the correct answer. Swaroop is saying D. Let's see what is the correct answer. Okay. Okay, so there were 4. There was daughter 1, daughter 2, son 1, and son 2. Annual income of daughter was 7,500 and 5,000. Okay. Son income was 5,500 and 1,250. Now you can claim the exemption because we are following optional tax regime up to 1,500 rupees or the amount of income clubbed, whichever is lower. So in case of daughter 1, the exemption would be 1,500. So that would be 6,000. The taxable value, the clubbing value. Daughter 2 is suffering from disability, so there would not be any clubbing applicable. This income is going to be taxable in the hands of daughter 2 herself. Okay. Now son 1 will also get the exemption of 1,500 rupees. So that would be 4,000. And for son 2, the exemption would be 1,500 or the amount of income clubbed, whichever is lower. So that would be 1,250. So there would be no income club. So income would be 6,000 and 4,000. The correct answer would be 10,000. I don't know how you are calculating 9750. That would be a difficult thing. Mr. Om Ram Krishnan is asked a very lengthy question. Invest rupees 75,000, rupees 25,000 out of gift. Okay. Just a second, Mr. Ram. Let me take the picture of your question. I will solve it, and in the next class, I will explain you. Mr. Raj makes a gift of 20,000 to his wife, Mr. I have taken the code of your question, Mr. Om Ramakrishnan, and we will solve it in the next class, which is on, I guess, on 7th. I will discuss this question, okay? Okay, Swati solved. I actually aggregated. Okay, that is a very common mistake which has been done by the students in the examination. When there's an exemption, they technically do the same thing. Aggregate exemption, they try to find out that 1500 rupees per child. That would be a dangerous thing to solve, because if any child is having income less than 1500 rupees, in that case, your answer would be wrong. Okay. Okay, one more question from Krishnan. Okay. Fine. So let's discuss the provision. We have already discussed the MCQs. There are only 6 MCQs from this chapter for today. Moving on to test your knowledge questions. And then we will solve May 2023 question. We could do one thing. First of all, we need to solve that May 2023 question. Look, question number 1 is exactly the same as we have discussed in the MCQs. Now, question number 2. During the previous year 23-24, the following transaction occurred in respect of Mr. A. Mr. A had a fixed deposit of 5 lakh in a Bank of India. He instructed the bank to credit the interest only. So income transfer without transfer of asset. 9% per annum from 1st April 23 to this amount to Mr. B, son of his brother, to help him in his education. So if you only transfer income without transferring of asset, that is not possible. So in this situation, 45,000 is going to be included in the hands of Mr. A from this transaction. First point. We have to find out the income in the hands of Mr. A. And there is also, they asked Mrs. A and the minor child also. So for all these, we need to calculate the income. So A point has been going to be taxable in the hands of Mr. A. Now, Mr. A holds 75% profit share in a partnership firm. Mrs. A received a commission of 25,000 from that firm for promoting the sales of the firm. Mrs. A possesses no technical or professional qualification. So what will happen? This is need to be clubbed in the hands of Mr. A, amount 25,000. Now, transaction number 3. Mr. A gift a flat to Mrs. A on 1st April 23 during the previous year 23-24. Mrs. A income from house property computed was 52,000 from such flat. So as per section 27, this is also going to be taxable as a deemed owner into the hands of Mr. A. That is 52,000. Okay. Now, Mr. A gifted 2 lakh rupees to his minor son, who invested the same in a business, and he derives income of 20,000 from that investment. So the accretion of income cannot be clubbed. But this is a case in which Mr. A gifted 2 lakh rupees to his minor son, who have invested the same in a business and derived the income from that investment. That is going to be clubbed in the hands of the parent having the higher income. So Mr. A is having the higher income. So this is going to be clubbed in the hands of Mr. A. Now, Mr. A's minor son derived an income of 20,000 through a business activity involving application of his skill and talent. This is not going to be clubbed. So this needs to be taxable. The point number E is going to be taxable. You can see in the hands of minor. That is over here. Now, during the year, Mr. A got a monthly pension of 10,000. He had no other income. So Mr. A having pension income of 10,000, that would be 1,20,000 rupees. And out of that, we can claim the standard deduction of 50,000. So taxable value of that pension in the hand of Mr. A is 70,000. Mrs. A received salary of 20,000 per month from a part-time job. So that means there is no substantial interest involved. So that would be 2,40,000. Out of that 50,000 reduction. So that would be 1,90,000 in the hands of Mrs. A as the income. So total income would be taxable in the hands of Mr. A after giving the exemption of 1,500 rupees for clubbing provision. For minor child income, 18,500. So total taxable income in the hands of Mr. A would be 2,10,500. Mrs. A income would be 1,90,000, and that minor income would be 20,000 rupees only. Clear? Now I guess we have to solve the May 2023 question. These are normal question. Question number 3, it's like a gift provision, very simple provision. The question number 4 is the investment provision. It's a very interesting question, a very important question. Kindly do try this. Now you can see it's a very interesting question. Why? Because a proprietary business was started by Srimati Rani in the year 2021. As on 1st April 22, her capital in business was 3 lakh. Now the interesting part comes into the action. Her husband gifted 2 lakh rupees on 10th April to her, and such sum is invested by Srimati Rani in her business on the same date, but it is not on 1st April 22. So the amount has been invested on 10th April, but for the previous year 22-23, there would be no clubbing in the hands of Mr. Husband. Why? Because the investment was not on 1st April 22. Only the clubbing provision would be applicable for financial year 23-24, because on 1st April 23, his amount of gift has been included in the capital value. So that's a very interesting question. Kindly do solve it, because we have to solve a lot of more questions. So moving on to the provision now. We want to solve the May 2000 question paper 2023. So we have the question number 4A for clubbing provision exclusively. Page number 16. So some student think that clubbing provision is not going to be asked in question, so I can skip that topic. Do not do this. You can see question number 4A, that was a marks weightage of 6 marks. It's from clubbing provision. It was so easy to solve. But if you will not going to study, or you're going to skip that chapter just because you think that that is not regularly asked in examination, so you might find that question or that kind of questions in your examination. So kindly do not go for selected study. Please go for comprehensive study. Do not leave any chapter. You have to cover each and everything. I have told you in my first revisionary class, you have to solve all illustration of study material, all test knowledge question, your RTP, MTP, and at least 3 or 4 previous attempt question. You have to solve it. If you want good marks, if you want to clear this examination, this you need to do and cover everything, whatever has been given your study material. Okay. So the question is this. Mr. Chaman, who is 50 years old, and his wife, Mrs. Chaman, who is 48-year-olds, furnish the following information. All of the amount of income, gains, etc. has been computed, okay, as per the provision of income tax. So if the salary has been given, that is computed salary. That means the standard deduction, etc. has been already done. If there's an income from house property, that means everything GAV, NAV, etc. has been calculated. That is your final income from house property. So Chaman's salary income is 11 lakh. Mrs. Chaman income from Kathak performance is 2,50,000. she is a professional dancer. So you know this 11 lakh is going to be taxable in the hands of Mr. Chaman only. The 2,50,000 is going to be taxable in the hands of Mrs. Chaman. Mrs. Chaman earned long-term capital gain of 5,50,000 from sale of shares. That is again going to be taxable in the hands of Mrs. Chaman. Mrs. Chaman gifted rupees 2 lakh to Mr. Chaman out of her Stridhan. Stridhan means that amount which has been transferred by husband to her wife on monthly basis for her personal expenditure, etc. So out of that accumulated Stridhan, she transferred 2 lakh rupees on 1st April 23. Mr. Chaman invested the entire amount in stock market but suffered a short-term capital loss of rupees 5,10,000. But the gift was up to rupees 2 lakhs. So the loss for the purpose of clubbing would remain only up to 2 lakh rupees. The loss would be considered for the purpose of clubbing as in the same case of income. But that would be up to rupees 2 lakh. तो लॉस 5,10,000 का है. लेकिन द प्रोविजन क्या कहते हैं? प्रोविजन कहते हैं कि जितना अमाउंट आपने दिया है हम सिर्फ लॉस उतने तक का ही कंसीडर कर सकते हैं. ओके, वी विल सॉल्व इट वन बाय वन. Then Miss Nena, the minor daughter, earned 3,50,000 by performing in various quiz competitions held online during the year 22-23. She kept the amount in saving bank account and earned interest of 15,000 during the year 22-23. So the amount he earned by way of her skill, 3,50,000, is not going to be clubbed. That is going to be taxable in the hands of Nena only. But the interest portion is going to be taxable in the hands of clubbed in the hands of parent who is having higher income. And Master Neelab, the minor son, earned 35,000 from fixed deposit, which was made out of the cash he received on his birthday from his friend and family. So till now we are going to club it, but Neelab suffered from a disability as mentioned under section 80U. The medical certificate shows disability up to 75%. So you have to calculate the income in the hands of Mr. A, Mrs. Chaman, Neelab, and etc. Ignore section 115 BAC pertaining to alternate tax regime. So you have to solve this question as per optional tax regime. Default is not applicable. If default is applicable, then that 1,500 rupees exemption would not be applicable. So we have to solve it without that default tax regime provision. So let me open this question in my other device because on this PDF file, my tab does not work. I don't know what is the problem. So let me open this question, then we will solve it. Revision class, clubbing provision. We have a question, May 23 paper. Just a second. So you could see how easy that was. It was not a difficult question. It was a very, very easy question. Okay. It has been page number 16. Okay, so the question is here now. Now we are going to solve it. That has weightage of 6 marks in your examination. So you can see how we're going to solve it. The question was asking, compute the total income in the hands of Mr. and Mrs. Chaman and their minor children. So we have to solve this question in the hands of all of them. So there's a particulars. Then we have Mr. Chaman. Then we have Mrs. Chaman. Then we have, I guess, Nana, minor son Nana, and minor Neelam. So he is an handicapped section 80U. So there is no point of clubbing in this case, of course. So one by one, the salary income was there of Mr. Chaman. Point number one, computed salary. We do not need to deduct any standard deduction out of it because it has been given in question that it has been computed salary. After this question, we will take a break. Then Mrs. Chaman income from Kathak performance. So that is also not going to be clubbed in anywhere. 2,50,000. She is a professional Kathak dancer. Then we have a long-term capital gain in the hands of Mrs. Chaman, that is 5,50,000. Now, point number 4 was very interesting, which says that she has gifted 2 lakh rupees for the purpose of investment. And Mr. Chaman has incurred a loss of 5,10,000, but up to the amount of gift only we can consider the loss. The balance loss would be carry forward in the future. Then the income by way of skill of Nana, that was 3,56,000. Now the interest income of Nana, which was 15,000 rupees, is going to be clubbed in the hands of parents having the higher income. So Mr. Chaman is having the higher income. So 13,500 is going to be taxable in the hands of Mr. Chaman. And the last income, which is for Neela, who is a physically handicapped, that was 35,000, is going to be taxable in the hands of Mr. Neelab. There is no clubbing in the hands of Mr. Neelab would be. So total income after these will be, this is the income of Mr. Chaman. Mrs. Chaman income would be 6 lakh. This is Nana income. And this is Neelab income. You can see it was for 6 marks question. May 2023. Question number 4A. So it was so easy to solve. And I believe everything is easy if you have prepared well for it. Nothing is difficult. So if you have gone through with the provision of clubbing, if you have done practice, if you have solved your test knowledge question, 3-4 attempt, last previous year question paper, etc., then I believe that it would be easy in every case, whether it's this question or anything, it does not matter. Pooja, send me a question PDF. Let me see. Pooja, let me take the screenshot of this question, and in next class, I will discuss it with you. Okay. Okay. Sir, is minor liable to file return? Yes, he is liable to file return, but he cannot file his own return. So his parent would file a return as a representative assessee. Liable to file, but he cannot file in his own name. So his parents would be going to file his return as a representative assessee, etc. Pooja, I will solve it in the next class. I will take time, I will solve it, and then we'll discuss in the next class. Moving on to the provision, we have discussed these provision. So clubbing provision has been discussed, and after the break, we will solve set of provision, carry forward and set of provision. So Mr. Ayaz, can we go for a short break of 10 minutes? Mr. Ayaz, are you there? Okay. After 10-minute breaks, we'll be back. Welcome back, everyone. So we will discuss now after the clubbing provision. Now the other topic is set off and carry forward of set off. Okay. Okay. Somebody, Komal Preet has sent me some screenshot. Okay. To whomsoever, जो भी screenshot भेज रहा है भेज दो. I will look at it after the class and we will discuss it in the next class. Okay. Pooja already sent me. Okay. Om Krishnan, you have also sent me queries. If possible, kindly send the screenshot because I have taken the picture, but I am seeing that it's not clear. So please send a screenshot. I will save it so I will able to check this later and able to solve it also. Okay. So the next topic is set off and carry forward and set off of losses. Very interesting topic, and it was continuously asking, like out of 3 attempts, in 2 attempts, the question regarding this chapter is going to be asked by the institute. And it's a very easy topic also, in my opinion. Kavita is asking, disability children, no deduction of 500 rupees. In case of disability children, there is no clubbing applicability. So if there is no clubbing is happening in case of children or any child, there would be no exemption concept has arisen. So exemption would be only applicable, Kavita, when there is clubbing applicable. So there is no clubbing because the income is going to be taxable in the hands of that child only. So clubbing concept does not applicable. Om Krishnan has sent me the queries. Okay, one and the other. Okay, done. Okay. So moving forward, the setup concept we are going to discuss with the help of the provisions. So there are 2 diagrams which has been prescribed by your study material. This is set off and carry forward and set off of losses under default tax regime under section 115 BAC. And you can see there is actually the set off concept has been divided into 3 categories. So if we start discussing the set off concept under section 115 BAC, so this is technically divided into 3 categories. First is inter-source adjustment, or we can say it intra-head adjustment, which means that the loss from one source of income under the same head could be adjusted from the income of the same head. So that's why we call it inter-source adjustment, or we can call it intra-head adjustment. So suppose there is a house property in which there is a loss under let out property, house number 1, and there is a profit in the other let out property, then the let out property loss could be adjusted against the let out profit operating house property. If you are running a business of trading and manufacturing, and there's a loss under trading business activities, it could be set off against manufacturing activity business activities. So that is called inter-source adjustment, which means under the same head, you can set off all your losses from a source of income against the other source of income under the same head. But there are some exception. Exception means there are some losses under the same head which are not going to set off from the same head other source income. So these exceptions are losses from speculative business. So if you are having a loss under a speculative business, so that fall under PGBP head. So if you have a loss under speculative business, say rupees 50,000, and you have a profit of textile business, profit of 70,000. So because speculative business does fall under the exception, so it cannot set off its loss to any other source of income. It needs to be get set off only against the other speculative business profit. It cannot be set off from any other source under the same head. It needs the profit from other speculative business. Suppose there is a speculative business profit also having profit of 30,000. then this 50,000 could be set off from this, and remaining 20,000 again cannot be set off from any other business activity except speculative business. Understand? Suppose in this example, if I've changed it like this, speculative business, suppose having profit of 70,000, and textile business loss is 50,000. So this business loss can be set off from speculative business because the exception is for speculative business, not for normal business. In this case, set off is possible and the remaining would be 20,000 profit of speculative business. So exception number 1 is speculative business. What is the meaning of speculative business, etc.? That has been already discussed in the PGBP chapter. You can go through with the details videos in which we have discussed the provision of speculative business. So first exception is speculative business. So speculative business losses could not set off against any other business income under the same head, but not vice versa. That means other business activity losses can be set off from speculative business. Clear? First point. The second is capital gain, and that is long-term capital gain, or we should say capital loss. So under the head capital gain, there could be long-term or short-term gain or loss. But long-term capital loss could not be set off against short-term capital gain. It required to be set off from the same source of income, long-term capital gain. So it is allowed to set off from long-term capital gain, but it could not set off from short-term capital gain. In the same way, as speculative loss could be set off from speculative income, but normal income can be set off from speculative, normal loss can be set off from speculative income. In the same way, long-term capital loss cannot set off from short-term capital gain, but short-term capital loss can be set off from long-term capital gain. So long-term capital loss is the exception. So whatever the exception, that means that loss cannot be set off from any other income, but not vice versa. So speculative business falls under PGBP head. Long-term capital loss is a part of capital gain head. Now we have the third exception for section 115 BAC, and that is from loss from activity of owning and maintaining racehorses. So if you are carrying on a business of owning and maintaining racehorses, and if you incurred a loss from this business, then that would be fall under income from other source head. That's a part of income from other source. It could be set off only against the profit from owning and maintaining racehorses. It could not be set off against any other head of income, any other source of income under the same head. So the first part is inter-source adjustment, which says in the same head, any source of loss could be adjusted against the income of other source under the same head, except speculative business, except long-term capital loss, except losses from owning and maintaining racehorses. So that was the first stage, that called inter-source or intra-head adjustment. Now the second step is inter-head adjustment. That was intra, now this is inter-head adjustment. That means the losses which would not have been, which could not have been set off under the same head, now can be gone into the another head of income to set off its loss. So now the provision says if the loss has not been or could not be set off under the same head or under inter-source adjustment, then those losses can be set off from other head of income, and we have again some exception. It's very obvious that those exception we have discussed earlier in intra-head would remain, of course, when the loss is not going to be set off under the same head. It could not be transferred to another head. So the exceptions are exactly the same. Speculative business. The second one is long-term capital loss. The third one is owning and maintaining racehorse. Now some more is going to join these persons or these losses. There is one short-term capital loss also is there. Now, technically, long-term capital loss cannot even set off against short-term capital gain in the same head. And it cannot go to any other head also. Now, the short-term capital loss also joined it for inter-head adjustment. That means short-term capital loss will not set off against other head. So technically, this full head cannot be set off from any other head of income. So capital gain losses, whether it's short term or long term, could not set off from any other head of income. Clear? Now PGBP head losses cannot set off from salary income. This is one more new entry in this. So PGBP losses could set off from income from house property, could set off from long-term cap gain, short-term cap gain, but it could not be set off from salary income. Even it could be set off from interest income, etc. But PGBP losses cannot be set off from salary income. So PGBP income cannot be set off, speculation and maintaining resources, loss on the capital gain, and losses from house property. Losses from house property again cannot be set off from any other head of income. So these are new exception. First one is this, second one is this, and third is income from house property. So house property losses could not be set off from any other head of income under section 115 BAC, under default tax regime. So that was second part. Now the third part is, that was set off. Part 1 and 2 talks about the set off. Set off means current year losses need to set off from current year profits. But if current year adjustment is not possible, if even after inter-head or intra-head, if there is any loss remains, then how we can carry forward and set off these losses? That is our third category. Some losses could be carried forward for 8 years and some can be carried forward for 4 years. So one by one, we can discuss these provisions also. And of course, you must have gone through with all these provisions in your normal classes. You must have watched those lectures in which the faculty must have told you that how these provisions need to be understood in detailed provisions. Okay. Now, what is the difference between 115 JB, 115 BAC and optional tax regime? Under optional tax regime, if you see, in case of intra-head adjustment, there are one new exception. Speculative business was same, long-term capital loss was same, owning, maintaining racehorse same, and now we have one more, and that is losses from section 35 AD business activity, the specified activities which has been discussed in PGBP, like oil pipeline network, cold storage businesses, warehousing businesses, hospital, hotel business, etc. So if there is any loss under section 35 AD business, it could be set off against the same kind of business, whether that business is availing that exemption 35 AD benefit or not. It does not matter, but the nature of activity of these business should be same. All those which has been mentioned under section 35 AD. So that is a new exception. In case of inter-head, there was speculative business same. Long term has been joined by short term. Owning, maintaining racehorse same. 35 AD is same. PGBP losses cannot be set off from salary income. That is the same provision. This is new. One new over here, one new over here. And losses from house property can be set off from other head maximum up to 2 lakh. This is also a new provision in this category. So this is a new category. And the third, of course, the carry forward and set off of losses. So you must have gone through with all the provision regarding these concepts. And in my opinion, this chapter is very easy to solve because there is just addition, subtraction, etc. So I can also show you a format. With the help of that, you'll be able to solve these questions very easily. Like it's a format in which if you put the value correctly, You'll be able to solve the question almost 95% correctly. And here is the format for all of you. Kindly follow this format in every question of set of whatever you want to solve. So suppose this is your GTI, not GTI, of course. There's an income under different heads has been given. You have to divide these income and losses as follows. Make a first category of PGBP, then a second category of capital gain. Then we have third category of house property head of income. Then we have salary. For the purpose of set off, you have to divide your income or losses in these 5 categories. And last is income from others. So there are certain subcategory also. Under PGBP, there would be speculative business. You have to mention separately. There is losses or income belongs to section 35 AD. For the purpose of section 115 BAC, this would not be applicable because section 115 BAC does not give deduction to section 35 AD. So for if 115 BAC, then there would be no 35 AD business subclassification. All will be fall in other category. Trading, manufacturing, etc. So if it is section 115 BAC, then only there will be 2 subclassification, speculative and other. Capital gain would have 2 benefit, long term, 2 classification, long term and short term. House property does not make a difference. Salary, there would be never loss in this category. Income from other source, I would divide in 3 categories. First is owning, maintaining racehorses. Second is casual income. Remember, there could not be any loss under the head casual income. No loss could be there in casual income because expenses not allowed. And all other would be in other category. So whenever there's a question, kindly bifurcate your income into these categories, in these different categories. And you will be able to solve that question very easily. First of all, just write it down the question in these categories. So first, if you are able to write it down the question in this category, then you will be really easy to solve these questions. Let me give you an example how you can solve these questions in this category. It really makes the question so easy to solve if we are following this category. So I have solved all the questions. Let me help you to solve. Okay, May 2024 question. We will solve the May 2024 question in this paragraph, okay, in this format. So it's question on page number 14, question number 4A. Over here. So you can see there's a question of 6 marks again. And the question says, Mr. Joshi, resident Indian, age 58 years, furnished the following details of his income for the previous year 23-24. Income from house property computed has been given 2 lakh rupees. So I need a bigger place to solve this question because I have made 5 different categories like PGBP income, then capital gain, then house property, then salary, then income from other source. So after reading this question, I'm just giving you a hint, then I will solve in details. So this is income from house property computed. So what I will do, I will write it down over here. Always remember, use the plus minus sign to identify a profit or a loss it is. Clear? Always use this sign so you will not be confused. Income from proprietary business 3 lakh rupees, that would go in PGBP other category plus 3 lakh. Okay. Short-term capital gain on sale of land 2 lakh rupees. So that would be the capital gain part. Short-term. I will solve this question in detail. Do not worry. 3 lakh rupees. Sorry, 2 lakh rupees. Okay. Short-term capital loss on sale of equity shares listed in recognized stock exchange. STT paid. So whether it's a loss or gain does not matter. That would be my loss. I will use the sign. Always use the sign. It would be really helpful. Then interest on bank fixed deposit, 50,000 received by his son, age 21 year, out of money gifted by Mr. Joshi in 2022. So it would not affect my income because now he's a major. So if it would have been a minor, then I will club that income into income from other source after claiming the 1500 rupees exemption. If that is a question in which we are shifting opt out of section 115 BAC. But because he's major, so we would not going to do anything with this point number 5 conditions. Okay. Next is loss from speculation business. Now it's a loss, so it would be part of my PGBP. You can see speculation business loss is 40,000 minus 40,000. Losses from owning and maintaining resources. I'm not doing anything. I'm just writing down the question in my format. If you follow this format, you will be able to solve this question so easily. So that is other source owning and maintaining resources. It would be minus 50,000. Clear? Now, following are the brought forward losses details. So, until we will solve this, we will not apply the brought forward provision earlier. First of all, with the information given in the question, we have to find out the intra-head adjustment. That means inter-source. And then we will solve inter-head. After that, brought forward, carry forward, etc., we will see, first of all, brought forward business losses, house property income is given in question is 2,50,000. Brought forward business loss of proprietary business for the assessment year 13-14 is 50,000 given in question. Then unabsorbed depreciation relating to assessment year 24-25, 1 lakh has been given in question. So the brought forward house property time duration is to set off is 8 years. Business loss is 8 years, that has been elapsed already. You can see 13-14 and we are talking about assessment year 24-25. So that has been already passed. So no treatment of this. Unabsorbed depreciation has infinite time period to set off. So we can use that. Brought forward long-term capital loss from assessment year is 90,000. So capital gain also having 8-year carry forward and brought forward provision. Return of income for that year was filed on 31st January 19 after due date of filing the return. So because the return has been filed after due date, so we will not be able to carry forward these loss also. So now the question says, compute the total income of Mr. Joshi for assessment year 24-25 and show the items eligible for carry forward, assuming that he exercised the option of shifting out of the default tax regime provided under section 115 BAC 1A. Now this question is going to be solved in that format in detail, and you will see how easy it is to be solved. So in the question, let me open that question in my other screen. Set of provision, that was November, May 2000. That was page number 14. Here we go. So the question says, first point, Mr. Joshi, resident India, age 58 years. Listen the question carefully and I will point it out. I will write it down where it required to be. The first point was income from house property computed 2 lakh rupees. So over here, I will write it down 2 lakh rupees income from house property. If you solve in this format, you will really find that set of questions are really easy to solve. Okay. Now, second point was, this is my first point, income from proprietary business, rupees 3 lakh rupees. So this will fall in this category, 3 lakh rupees. Clear? I'll also mark in my solution. Now the short-term capital gain or sale of land is 2 lakh rupees. So that would be 2 lakh rupees. The short-term capital loss on sale of equity share listed in recognized stock exchange is 75,000. So whether it's a profit or loss, we have to consider is 75,000 rupees. Clear? The next point is interest on bank fixed deposit. 50,000 received by his son, whose age is now 21 years, gifted by Mr. Joshi in 2022. So that would not be clubbed in my hands. So he's a major son now. So there would be no treatment in this regard. Losses from speculation business is 40,000. Clear? So it's been done. Now losses from owning and maintaining racehorses is 50,000. So I'm just not doing anything. I'm just writing down the question in my format. And when I'll finish it, I'm almost solved my question, except the addition and subtraction, what we need to do. That except that almost everything has been sorted out. So we have written down the speculative losses. My PGBP income 3 lakh. Short term is 2 lakh and 75,000. House property profit is 2 lakh. There is no salary income. There is owning, maintaining horse race losses 50,000. So after writing down the question, now what we need to do, first we need to do the inter-source adjustment. After that, speculative losses cannot be set off from other income. So that would remain 40,000. This will remain 3 lakh rupees. This would be after adjustment would remain 1,25,000. Then house property profit would remain 2 lakh rupees. No salary income, and this is going to be 50,000. So these were the exceptional cases. We have discussed that speculative businesses, speculation business having exceptional cases. It could not be set up from any other source. It could not be set up from any other head of income. So this is directly going to be carry forward. So one carry forward we have find it out, and same in case of owning, maintaining racehorses. This is also going to be carry forward for future years. Sorted. Now the other information I'm going to read. Now the question says brought forward house property losses. Now we have no losses remain. So 2 losses need to be carry forward. That is for speculative business, and that is from owning, maintaining racehorses. There is no other losses for inter-head adjustment. But now we have brought forward losses. The question says brought forward house property loss of assessment year 21-25 is 2,50,000 rupees. So house property loss, we have house property income of 2 lakh, but the loss is 2,50,000 brought forward, and that is for assessment year 21-22. So we have 8 years for the setting of this loss, but out of 2,50,000, we can only set off 2 lakh rupees. So that would be make my house property income nil. The remaining 50,000 could be carry forward. That is my third carry forward losses, that is income from house property. Clear? Now brought forward business loss of proprietary business from assessment year 13-14. So 13-14 assessment year losses of rupees 50,000. That would be not relevant, not applicable, because 8 years has been expired. 8 years after that year in which the loss incurred, that has been already passed on. Now we have unabsorbed depreciation, which amounts 1 lakh rupees. It has infinite time to get set off. So we can set off it in this year also, and we will have remaining business profit of 2 lakh rupees. Clear? So we have now PGBP income 2 lakh. UD has been completely absorbed by the profit. The last point is brought forward long-term capital loss from assessment year 18-19 is 90,000. Which could be set off because we have still having the years, but because the return has been filed after due date, so that 90,000 also lapsed and it could not be carried forward and set off. So after this, you can see now we have GTI. We have this income and this income for the purpose of GTI. So my GTI will remain 3,25,000. And we have losses to carry forward. This is my first loss to be carried forward. This is my second loss to be carried forward. And this is my third loss to be carried forward from this question. So this is the solve question of 6 marks question. For the purpose of your examination, you can see with the help of this diagram, you can find it out that how easy to solve these kind of question in your examination. I have one more question, I guess. In November 2023, one more question has been asked. Let me solve that question for you. That is November 2023. We have that question. This is question number 4A, page number 14. Sir, why long-term cap gain 90,000 not carried forward? Om Krishnan Gupta, there is a section 139.3, return of loss. And it says if you want to carry forward any loss except income from house property, you need to file your ITR before due date. Let me show you the provision in your notes. You must have seen this provision. This is very important. For the purpose of claiming the deduction, you have to file your return also. So there is a provision, submission of return of loss under section 80. The last section of your, I guess, set of chapter, yes. And it says as per section 80, business loss under section 72(1). Speculation losses, losses from a specified business, losses under that capital gain, losses from activity of owning and maintaining racehorse, which not been determined in pursuance of written fund section 139(3), cannot be carried forward. Thus, the assessee must have filed a return of loss under section 139(3) in order to carry forward and set off of such losses. Such a return of loss should be filed within the time allowed under section 139(1). So this condition does not apply to income from house property losses. But for any other loss except income from house property, you have to file your income tax return up to due date of ROI under section 139(3). Section 80 of set off talks about it, which is correlated with section 139(3). So they both are interconnected. You have to read section 80 as well as section 139(3) to understand the whole procedure. Om Krishnam is saying, sir, it means when it is given in question, return is filed for long-term cap gain, then we have to. So if return is not filed for long-term cap gain, if the return of income has been filed by the assessee up to due date of his ROI, then only you can carry forward any losses. Otherwise, the losses will be lapse. Okay. We are on November 2023 paper, page number 14. So here's the question. Set up with a very interesting and as well as important topic for examination. Please. Okay, Mr. J, a resident individual, furnished the following particulars of his income and other details for the previous year 22 and 23. Income from activity of owning and maintaining racehorses. So we know what we need to do with this. Okay, my pen was not working here. Okay. So income from owning and maintaining racehorses. Income from crossword puzzle solving, casual income. Income from agricultural land in Haryana. It would be an exempt income. Clear? An exempt income would be exempt, nor the losses will be treated, nor the income has any treatment. So it would be zero for the purpose of set off and carry forward. So if there's any exempted income, treat it like a zero for your set off, etc. question. Dividend income from domestic company, that is income from other source part. Expenditure incurred in collecting the aforesaid dividend 2,500 rupees. So in case of dividend, etc., only interest income, interest expenditure can be deducted. No other expenses can be deducted for collecting, etc., in respect of dividend. So this 2,500 has no treatment. Now income from cycling business, it would be a normal business category income. Losses from warehousing facility for storage of edible oils. So that does not fall under section 35 AD because that is not for edible oils. That is for other kinds of oil, but not for edible oils. Okay. Share of losses from PR associate of firm having 4 equal partners in which he is a partner, 23,000. That is also an exempt income because if any profit has been received from a partnership firm, that would be exempted in the hands of that partner. The following items have been brought forward from the assessment year 20-21. So we are solving this question for assessment year 23-24. Okay. Brought forward losses from house properties 1 lakh. Losses from the activity of owning and maintaining resources 37,000. Losses from gambling. It's not possible. I have told you casual income cannot have loss. You cannot set off any income from any losses from casual income, and there could not be any loss under casual income head because expenses are not allowed to set off. So if there is any case where expenses are not allowed or disallowed, there could not be any loss ever. Unabsorbed depreciation, we can set it off, and speculation loss is also given in the question. More information, Mrs. J, wife of Mr. J, got a salary of 1,20,000 from PR associate during the year 22-23. She is not qualified for the job. So that means the clubbing provision also applicable. And the income would be clubbed in that head of income in which it would be taxable if there is no clubbing applicable. So clubbing do not have any other head of income. We have only 5 heads of income: salary, PGBP, capital gain, house property, other source. We do not have any separate head like clubbed income. So the clubbed income, if any, is going to be clubbed, then it is going to be included under the same head of income. It would have been included if there is no clubbing provision applicable. So if Mrs. J is getting salary, so salary is going to be included under Mrs. J salary head of income. But now it's going to be clubbed, so it would be clubbed in the hands of Mr. J salary head of income. And compute the gross total income for assessment year 23-24, ignoring the provision of section 115 BAC. I will again make that format, and in that format we are going to solve these questions one by one. How we identify that Mr. J having substantial interest in that organization? Because you can see the share of loss equal 4 partners. So it's trying to explain that the share is 25% of each. So we have more than 20% profit sharing ratio. So Mr. J having substantial interest in that firm. And because Mrs. J is not qualified, so this is going to be clubbed in the hands of Mr. J. Okay. So let's solve this question. Sir, a clarification by BSc regarding house property losses cannot carry forward. Is it applicable for J25? Yes, it is applicable for J25. Correct. Okay. Now let's solve this question again in the same format as we solved it. That is technically our incomes detail. One head would be PGBP. Even without reading the question details, I would write speculative business 35 AD. I will make this subclassification even without seeing into the question what informations are necessary. Then capital gain, long term, short term, then income from house property, then we have salary, and then we have income from other source, in which there would be casual income, there would be owning, maintaining resources, and there would be others. Fine. Now I will read the question. I will put the information in this format, and you will see when we will put the complete information in this format, we would be able to solve this question almost completely. So income from the activity of owning and maintaining racehorses. So I should write it down over here. That is 40,000. Please use the plus and minus sign always. Okay. Then income from crossword puzzle solving. That would be my casual income. That is income. So I would add it over here. That is 30,000. Income from agricultural land in Haryana. I've told you whatever is exempt category income would not form part of this format for the purpose of set of etc. You assume the loss or the income from exempt sources income as nil. So I would not do anything with this agricultural income. Dividend income has been given 15,000 and there is an expenditure also given 2,500 for collection. So that is not eligible for deduction. Only interest expenditure could be claimed. Income from cycling business has been given over here. So that would be 1,50,000. Then losses from warehousing facility for storage of edible oils. That would not form part of 35 AD. It would be a normal business activity. That would be 1 lakh. Then we have a share of loss from partnership firm. So profit is exempted if received from partnership firm, and the same way loss would not be having any treatment because loss or income both having exemption if you receive it from a partnership firm as a partner. So we do not need to do anything with that. Now share of loss has been covered. Now we have the following items have been brought forward. So we have complete the inter-source details over here. I would mark a line over here. So I would understand that my first part has been completed. We do not have any long-term details. We do not have any short-term, etc. So that was 23,000 loss. That need not to be done anything. So after that, now we have 50,000 business income. Casual income is of course 30,000. Owning, maintaining is 40,000. And 15,000 is other source income. But what we have left a salary income. That is from Mrs. Jaya. So that is club salary. 1,20,000, that was the salary has been given in question. 50,000 would be the standard deduction. So remaining would be 70,000, my salary income also now there. I hope it's clear. After that, now the provision says loss, brought forward loss from house property has been given 1 lakh rupees. So brought forward house property losses can be set off only against the house property income. So there is no house property income, so it is going to be carry forward. Clear? Losses from the activity of owning and maintaining racehorses. Now this could be set off from this value. So this 37,000 losses from 20-21. So we have almost 4 years for set off these kind of losses. So we can still set it off. So that would be remaining 3,000 profit. Then we have losses from gambling. It's not possible. Losses from gambling not applicable. It cannot be casual income, cannot have any losses. Then we have unabsorbed depreciation of 15,000. We can deduct it from this value, infinite time period to get set off. So remaining business profit is 35,000. Speculation losses. There is no speculation income. The losses is 20,000, which has been brought forward. So we technically going to carry forward this losses. So that is my first carry forward. This is my second carry forward. Now the income is, this one is my income, 35,000 plus 70,000 plus 30,000 plus 3,000 and plus 15,000. It would come aggregate of 35,000 plus 70,000 plus 30,000 plus 3,000 plus 15,000. It would be 1,53,000 would be my GTI. And that is my answer. This question was for 7 marks in the examination. And it is 100% so can be solved easily. If you follow this format, you will be able to solve this question so easily. You have to write it down the working notes, etc. But the problem is when you try to solve a question in a vertical form. So it would be really difficult that from which income you need to deduct the losses. So if you use this horizontal form to solve a question, it would be really easy to understand from which income I need to deduct the losses or not. So it's my opinion that you should try this format to solve these set of questions. Okay. Let me see if there is any query. No query yet. So that was the way we could solve these questions. Now we have the MCQs for set of provision. Very easy. Only 6 MCQs are there to solve. Okay. So one by one, I'm going to ask you the question. Let's see you able to solve them or not. This question number 1. Losses under the head of PGBP cannot be set off against which head of income? Very easy, of course, very easy. The losses of PGBP cannot be set off against which head of income? Okay, Pooja is saying C, Kavita also saying C. Shoaib is also saying C. Satyapriya Nayak is saying D. Very well done. Satyapriya Nayak, how it's possible? We just discussed that PGBP. We have discussed the exception also. The PGBP losses could not be set off from salary income. So the correct answer is, of course, C, not D. Okay. Income under the head salary. Next. Which of the following losses available after inter-source set-off cannot be set off from incomes in other heads in the same assessment year under optional tax regime? What is the correct answer? Okay. Shoaib is saying D, Satyapriya C, Om Krishna is saying D, Kavita is saying B. Okay. But the correct answer is, of course, D. These are exceptional losses. These do not get set off from the any other head of income. Speculation could be only set off from same source of income. Same in case of 35AD, even capital gain losses cannot be set off under inter-head adjustment. So the correct answer is, of course, D. Well done. For how many years unabsorbed depreciation can be carried forward? Very, very, very simple. And the easiest, most easiest. The correct answer is, of course, B. Mr. X has earned salary income of 5 lakh and he has suffered loss from house property amounting to 2 lakh 50,000. Speculation business loss is 1 lakh. Find out the gross total income under optional tax regime. Om Krishna is saying B. Swati is saying B. Sattva Priya is saying B. Kushi is saying 5 lakh. That means A. Okay. Under optional tax regime, we are asking. Okay. Kavita is saying A. Very good. The correct answer is, of course, B. Because the losses from house property can be set off from salary income. Business losses could not be set off from salary head, but house property losses can be set off from salary income up to maximum 2 lakh rupees. So my salary income is 5 lakh. Up to this 250, I can set off this 2 lakh rupees. So remaining would be 3 lakh. Speculative loss is going to be carry forward. The remaining 50,000 loss from house property is going to be carry forward. So remaining GTI would be only 3 lakh rupees. The correct answer is B. Next, Mr. A has earned salary income of 5 lakh and he has suffered losses from house property amounting 25,000. General business losses is 1 lakh rupees. Find out the gross total income as per optional tax regime. Very simple, of course. Same question as we asked in question number 4. There is nothing different in this. Correct answer is 4,75,000. Kushi is saying 3,75,000. What's wrong with you, Kushi? Business losses cannot be set off from salary head of income. So this loss is going to be carry forward. This can be only set off. So the correct answer would be 4,75,000. Next, last. Mr. H, for previous year, business loss is 1,30,000. Income from salary is 240. Speculation gain is 110. His total income for the assessment year under optional tax regime would be. Om Krishna is saying C. Shoaib is saying C. Swati is saying C. Very good. Sattva Priya Nayak is saying C. Well done. Swaroop is saying C. Pooja is also saying C. Why it's possible? Because business gain is 1,10,000 speculation gain and loss is from normal business. So this could be set off. So out of this 130, we can set off 1,10,000 from speculation gain. So remaining 20,000 loss of normal business going to be carry forward. Clear? The salary income is 2,40,000. That is the only income which remains. Business loss could not be set off from salary. Correct answer would be C. Clear? Good. So you must have seen that these two chapters like clubbing and setup, these are very simple. I guess in study material, both having like 18, 19 pages theoretical provision other than the revision part and the test knowledge questions. So very compact provisions, but still very important. In my opinion, there would be a question either from clubbing or a set of question in every attempt. But it might be possible that both can create a numerical question, a practical question, the same attempt also. So that two chapters are very easy and it's a good thing if these kind of question has been asked in the examination. you would be able to score full marks, whether it's 5 marks question, 6 marks question, or 7 marks question. So whatever marks they are going to be asked in examination, you would be able to score complete marks in these two chapters. So kindly do not avoid these kind of chapters thinking that might be not going to be come in examination. It would not be there. It could be asked in examination. And if you are able to read the provision carefully, you are able to read the question carefully, I believe that you can attain full marks in these chapters. So if there's any query, kindly ask me. Then we have our next class on, I guess, 7th of November regarding deduction, which is a huge, huge chapter. Okay. You can send your query on query portal also, or you can ask me your query over here. So I guess there is no query. Everything has been cleared. Please follow and please try to solve test your knowledge question from set of topic with the help of that format. And then you will see how easy it would be to solve these set of question in your examinations. Okay. So, Mr. Ayas, can we close out the section? All queries has been done. We can close this session. Welcome, everyone. Mr. Ayas, can we close this session? Welcome, everyone. Thanks for your thank yous. Ayas. Right here.